The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for being with us this evening. Good morning to my friends in Queensland. Good afternoon, I think, to the rest of Australia, which has daylight saving. And good afternoon across the ditch in the Shaky Isles. Hank, how's the volume? Can you hear me all right? Everyone hear me? Just type in question box if you're having difficulties. Yeah, 1, 2, 3, 1, 2, 3. Got it. Great. David over there in New Zealand. Thank you, David. And Hank down in the Hunter Valley. So that's great. That's a nice spread of country. If you can hear me there, they'll hear me everywhere. Well, folks, what a business it's been. I mean, a bit of volatility and the markets have just been absolutely sensational, haven't they? I mean, just by Tuesday this week, we were sitting on Wednesday was even better, 28,000 for one long oil contract, 6,000 in the S&P, 13,000 in gold, 1,500 in that's pretty modest, Russell, 14,000 in wheat, was 18,000 the day before. Just amazing stuff, isn't it? A bit of volatility makes all the gifts come to you so much quicker. Which is wonderful stuff. Okay, so we've been getting rained on in Australia, the East Coast, in particular Queensland and New South Wales. We've got La Nina, which I think I've got it right. I may not have. That's supposedly where the warm water, the pool of warm water in the Pacific, has moved over to the west, closest to Australia. The opposite part of that, El Nino, is the opposite, when that pool of hot water in the ocean moves over to the east, towards California. But I have never seen rain like that since, I can't remember when, to be honest with you. It's just rained and rained non-stop for about 5 or 6 months now. We've had some terrible flooding. And it's been dreadful. The people in Brisbane, there's 50, 60,000 people displaced with flooding. Down in New South Wales, well, up north in Queensland, it's worse. And down in New South Wales, absolutely dreadful, tragic. The small city of Lismore, wonderful, wonderful place, completely flooded out for, I think, the 5th time in about 7 years. Might be the 3rd time in 7 years. I may have inadvertently exaggerated, but it's tragic. I mean, there's not a shop left open. Everything is just absolutely wrecked with floods. It's extraordinary stuff. Chip, thank you, mate. Hope we stayed dry above water. Oh, I see, for once on time. Good for you, mate. Yeah, well, we're fine. I mean, the bottom of the garden's soggy, but we're raised up here, so we're okay. But boy, I mean, I'm so sorry for the people who've suffered in these rotten floods. They've gone on and on and on, and it's like a bad toothache that never goes away. Every 2 or 3 years, every 4 years, we seem to have these massive floods, and you know, it costs billions and billions of dollars in insurance payouts and remediation work, and it never seems to get any better. And you know, the solution to it is not clear. People have an idea that, oh well, buy out everyone, excuse me, who's got a house that's affected in the flood and relocate them elsewhere. Well, you know, A, the cost is astronomical. B, people don't want to be doing that. A lot of people are prepared to put up with floods now and again to be with their community. And either way, it just causes troubles, and we don't want that. Anyway, Chip, good to hear you're well. So there's a whole lot of our usual friends are here today. Akshay's here, Albert's here, Bob's here, David from New Zealand, who's running a leader-follower program with Striker. I hope that's going well for you, mate. George Tar, Greg the money manager in Colorado Springs or Texas. I think he's in the process of moving, going elsewhere. Hank in the Hunter Valley, Jeff Sherbrun. Good to have you with us, Jeff. He's a long time Danielcode supporter. Joe, of course. Mark, never start a party without Mark. He's always with us. Tutorial guy, says Michael Mitsos, the dentist from Chicago. He's a tutorial guy from long ago. Very, very good trader too. Murph is with us. I'm talking to Murph this week. He's recovering from a nasty car accident. Our thoughts are with you, Murph. Nathan, good to have you with us. Ned as well. Peter Mack, who's not a short-term trader. Oh dear, we've got so many good friends who support us so well. They're always here. Stephen's with us, Todd's with us, Trevor's with us, a whole lot of others. Yes. Oh, this is great. David Beecham, who you've heard me talk about. David came and did a Danielcode tutorial not so long ago. I mean, time flies, but as I talked about him maybe 2 or 3 months ago, and told you he was running a leader-follower program with Striker, and using Danielcode trading time, what I taught him at the tutorial. And he said, yeah, he's going well. He's ranked number 2 for accounts over 20,000 at Striker. And let me tell you, folks, that's a seriously big deal. Seriously big deal. There's some very, very clever people who run leader-follower accounts. And what it means is the operator, that's David, and I assume Jonathan in this stage, his partner. I don't know if Jonathan's still with you, David. I assume he is. And David creates the signals and runs his own account with Striker. And if you wish, you can pay him a small fee, and you can copy his trades. Oh, yeah, Jonathan runs a different account. Okay. So, David, congratulations. That's a seriously big deal to be doing that well. Keep at it, mate. You're a great advertisement for the Danielcode, and I wish you more strength to your arm. Okie doke, let's move on. So where are we? Here we are. So much happening today. Boy, markets rational, orderly, and sometimes predictable. Isn't it interesting with the Danielcode? The more volatility you get, the better it is and the more accurate it is. And this burst of volatility we've been getting, I mean, we've just had some absolutely fabulous trading during the last 2 weeks. So welcome to Leprechaun Heaven. This picture I had didn't convert terribly well because it's in all the colors of the rainbows. I just wanted to put this in to make you aware that what I'm telling you is some of it's with tongue-in-cheek, the rest of it isn't, but enjoy it. So, and here you can see, if you found your way here, at least you know about Leprechaun Heaven, where every rainbow has one or more of our little Irish friends waiting at the end of the rainbow. And honestly, if you become a Forex trader in particular, or a futures trader in particular, I should say, either of them, but futures more so, you've done very, very well. And if you've even got to this webinar, you're aware of futures, you've done very well because the system is against you. The system is dreadfully, dreadfully biased against you. And something, an article in Wall Street Journal came up this week that I've often thought about this, and I've been annoyed about it before, but I actually was annoyed enough to write them a note telling them that they're financial journalist, who I'm sure is a lovely guy, but almost all financial journalists come from an economics background, and they don't know a lot about derivatives. And what they do know, they are a bit scared of. I'll come to that when I get there, but there has been some immense drama in derivatives markets over the last 2 weeks. Some of it has been unbelievable. One Chinese company having a margin call of 8 billion with a B dollars, a margin call on nickel. In fact, the London Metal Exchange, which runs the nickel market, it's blown up, and they've had to try and back their way out of it. And of course, it's a Chinese company. And you may or may not know that the LME, the London Metals Exchange, where this stuff trades, is now owned by a Hong Kong company. So obviously they've had an issue of default, a major instance of default, and have done nothing about it in the sense of what they're supposed to do under their rules. But what they've done instead is they've closed the market, they've cancelled tons and tons of trades, and tried to make the pain a little more bearable for this major client who's got themselves in difficulties. That's one we know about. I suspect there's quite a few others not quite so dramatic that we don't know about. And that's volatility in nickel has been the same. We've seen it in grains, we've seen it in coal, we've seen it in oil, we've seen it in a lot of markets. And people who are trading those markets, the biggest and the best in the business, you would think, don't always know what they're doing, as I'm going to show you. So you might find this interesting. There's certainly a message in it for anyone. So the background of markets is that there's a weird overview of them. Investing in stocks and shares is considered virtuous, and it's massively advantaged by government subsidies through most of the Western world's taxation systems. You have your 401ks, we have different requirements, but they're much the same. And if you're in a particular account that you nominate investing in stocks, the benefits from a tax point of view are massive, absolutely massive. And the stock market itself is rigged, not in any massive way, but enough to make long-only trading a factual requirement for most private folks. To short stocks is a complicated business, and it's made that way on purpose. So for most private folks, private investors, shorting stocks is not an option. So they're locked into a long-only position, and that's by dint of policy. Government wants you to be locked into the long-only positions. They've suffered regulatory capture as well from the brokers, and brokers only want long positions. Most of them don't understand how you short stocks and what the equivalent risks are. But investment in stocks is rigged to make long-only trading a factual requirement for most private folks. The naughty stuff, that shorting stocks, is reserved for the players. Think about that bias. It's absolutely massive. Really massive. Okay, so understand that stocks and shares in the indices are mechanically biased by design. The weaker stocks are periodically removed and replaced by the hot new thing. Stocks that trade below a certain level are automatically removed. So the indices, Russell, Dow, S&P, that's just a few of them. There are hundreds of them around the world. They're designed to always rise over time. And that's the broker's favorite tool, the long index chart that is almost always rising from left to right. A few years ago, I was at a convention in Vegas, a traders convention, where I felt very lonely because there was a massive turn up of exhibitors and people giving presentations, as I was. But I got the distinct feeling that I was the only futures or Forex guy there. The rest of the world, it's all about stocks. It's just absolutely massive. So these are some of the reasons why. So the best known derivatives are futures and options, and to some extent Forex, but there's a huge group of derivatives that are OTC, over the counter, or private label derivative agreements, which are negotiated with brokers, with third parties. And all of them have the same basic quality. They refer to a third or fourth product on which the derivative contract is based. So when we trade the S&P, for example, don't forget we're actually trading a contract based on the accumulated prices of the component stocks in the S&P index as they trade on the New York Stock Exchange. So we're a bit parasitic in that way, but for the most part, we're speculating on future price movement. And speculators are an essential part of the market. If you think about it, we have the people who create products, guys who grow grains, for example. We have people who are intermediaries in the use of that product. You have mills that are buying grain to make into bread or stock feed or some other purpose. But even though there's a whole lot of those people, there's nothing like enough to create a liquid market, by which I mean that there's enough depth in the bid and ask that you can get your orders filled promptly all the time at any time during your trading hours. And that's where speculators come in, and that's what we are. We're speculating on price movement. That's what we do. So to all those long-suffering souls who buy and hold stocks, and I pity you. I pity you if that's all you know. We future traders in particular are most grateful. So in polite company, I've said here, investments in stocks and shares are virtuous. You see people talking about their stocks and shares all the time. It's a common lunch and discussion matter, as a common cocktail party item. But stocks and shares are seen as a vital tool in the raising and allocation of capital, which is the basis of free enterprise. Whole forests have been destroyed to provide the paper on which a multitude of articles, opinions, strategies for investing in stocks are written. By complete contrast, trading in derivatives is frowned upon. Naughty children in brokers' households are threatened that a futures trader may come and grab them if they're naughty. And I put in a ha there so you know I'm joking. You've got to be so careful what you say these days, haven't you? Options trading is worse. Buying calls and puts is about as close to a bookmaker as you can get without actually going to the racetrack. Option writers, by contrast, are wise, and that is why statistically 87% of options continue to expire worthless. Some bias, isn't it? So this doesn't happen by accident. Nothing happens by accident. There's a share market propaganda machine, which is massive. And in this, we see the media complicit. Of course, they're complicit. And regulatory capture is something we're all familiar with. But in the same way, journalistic capture occurs for the same reason. Journalists want to be on good terms with the people whose companies they're covering. They hope for a bit of inside information. They may hope for an invitation to some drinks or something to eat or some other social event. But journalists are humans. They like to be liked. If they can make a friend who's useful to them and reciprocate, they will. But almost all financial journalists come from the same dreary background, economics, or what I call the science of being a witch doctor. Economists can usually describe the symptoms, but never the time. And of course, time is the essence of derivatives trading. And this burst of extreme volatility, which is all tied up with the Ukraine invasion and the subsequent sanctions, and to a lesser extent inflation, it's seen real carnage in several futures and other derivatives markets. And I've put a link down there for you to have a look at. And I'm using some of that material. It's at Zero Hedge. And that's a link on this latest scandal on the London Metals Exchange. And it's quite extraordinary stuff. If you weren't aware of it, you'd simply say it can't happen. But it has happened, and it is happening. And what got me going off on a rant about this was that earlier this week, the coal giant Peabody got caught on the wrong side of a margin call. And they've had to borrow $500 million or so with an expensive 11% Goldman credit facility to make the payments of their margin calls. Others, this is from Zero Hedge, you can see they're talking about the Chinese giant. This is the business that's lost $8 billion with a B in margin calls on the London Metal Exchange. They're massive producers of nickel, but not the nickel that is required to lodge at settlement at the London Metals Exchange. So, in fact, the LME is now owned by a Hong Kong company whose biggest shareholder is the Hong Kong government, and that has been a puppet of China for a long time. That's obviously made things a bit easier for him. And extraordinarily, the LME chief executive, his name apparently is Matt Chamberlain, he told Bloomberg TV if the exchange hadn't cancelled trades, several brokers would have struggled to survive, which is a euphemistic way of saying a ton of brokers would have been broke. And they've had to take extreme measures. So you can get all into high dudgeon about that, but the LME, to me, has always been a bit fruity. A lot of the skullduggery on gold contracts centres around the LME and the London price fixing for gold. But I'm grateful that the main futures derivatives markets, CME, ICE, and others, plenty of them in Europe, they've all handled this very, very well. And it's obvious that there's a super flaw in how we're trading, how we're teaching people to trade, or more importantly, not teaching them to trade. So you can read all this. This is about Xingshan Holdings, who are the crowd that had the $8 billion margin call on the LME. Massive nickel producers themselves, but not quite the right sort of nickel to lodge as security on a futures contract. And the other thing we're seeing is this dramatic reshape of the global energy landscape. So, I mean, Germany for years, for decades, has been going down this route of getting rid of their energy, shutting down their nuclear power stations, phasing out coal-fired stations, relying more and more on clean energy, but backed up by massive and most efficient imports of oil and gas from Russia. The big one, of course, has been Nord Stream 1, massive, great big pipeline from Russia straight into Germany. And Nord Stream 2, built to completion, sitting there, massive cost, not going ahead. This is the reaction to Russia's behavior over Ukraine. But I was more interested actually in how the markets reported this issues that we've seen this in oil with in coal rather with Peabody. We've seen this in nickel with this company I've just been talking about, and there have been many players in grains who've lost their tails. And it's interesting that because journalists either don't know or won't report the reality, it's all glossed over. In the confused world of businesses, using derivatives to lock in profit margins, hedging your profit margin, that's good. And trading in derivatives is bad. And, you know, this comes from absolutely total and utter ignorance. This is the world is flat argument. If I can't do it, it can't be done. And there's so many people in business and the financial world who know nothing about derivatives, but they want to bark them down. They're risky, they're dangerous. In fact, you probably heard me say now, I used to trade stocks when my dear father was alive. He was a great man for the stocks. And I used to trade stocks and shares with him. Since I've learned about futures in the last 30 years or so, I don't own a stock, and I wouldn't own them. I think they're too dangerous. And I've been a director of and chairman of a couple of public companies, and I've got some idea of what goes on. I don't want to say more than that about it, but what happened with this Peabody blow-up is it was reported in the Australian newspaper, which is the leading newspaper in Australia. It's part of the Murdoch stable, and that was on Tuesday. And they were reporting about what's happened with Peabody and their margin call, where they've had to borrow $500 million from Goldman and other members of the syndicate to pay it. But they went to some pains to stress this was not trading, it was hedging. It was a derivatives contract that went wrong. And there's this whole range of big producers, from grains to coal to nickel to many other products. They are producers of the product, and they use hedging strategies. They use derivatives to hedge their price. In other words, exactly what happens with Peabody. They've got millions and millions of tons of coal in the ground, and they employ very, very clever young men whose job is to pick the top of the business cycle for coal. When that cycle gets into view and they can see a price that they think is attractive enough, they sell derivatives. They sell futures for a fact. They have many other derivatives, private label derivatives, doing the same thing, exactly the same as a standard futures contract. So they've sold the asset, or they've sold a futures contract on the asset to lock in the price and give them price certainty. They've guaranteed their profit margin at that stage, so they think. But this is a method of business that we've seen all these blow-ups, what I'm talking about now, in grains, in coal, in nickel, and other things. They've all come from the same reason. Producers have hedged to lock in other words, they've sold a contract to lock in a price that they thought was attractive. But because they know nothing at all about trading, and I don't know how they get into this strategy. I mean, I assume it's the Wharton Business School answer for hedging, that you have the physical asset that you're either growing or producing or creating, and you hedge on the derivatives market to lock in a price. Well, as far as that goes, that's fine. Nothing wrong with that. That's basically a pretty smart strategy. But the problem is, look at this. This is what happens when you haven't locked down the actual risk. This is wheat, which has had 2 spectacular days of lock limit up. It's been wonderful. We've been long wheat for weeks, really. Just fabulous stuff. But let me see, that whole Wharton Business School approach is wrong, because it ignores the first and only rule of futures trading. And for me, my only rule is there are no orders without corresponding stops. You should never, ever contemplate or have an order without a corresponding stop. And that stop's got to be tied exactly at the time you put your order on. You put on your if done or OTO order for your stop loss, so it automatically goes on as soon as your order is filled. And if you don't, like Peabody, like this nickel company I'm talking about, like many of the grain growers, they think they've got a hedge. So it raises the question, when is a hedge and not a hedge? Well, when risk is not controlled. If you've hedged through a derivative instrument to sell your product to guarantee you've set a price for that part of your product, that's fine. But unless you've got a stop loss order, I mean, is it hubris? Is it negligence? Is it sheer incompetence that the thoughts never crossed their mind that markets can go up, that there can be a squeeze, that sometimes the squeeze can be dramatic? I mean, we see it periodically. We've had a couple of them in natural gas in the last year, not so long ago. How is it that senior guys making multi-million-dollar decisions, and presumably they get paid accordingly, they simply don't know the basics of what a hedge is? I mean, to me, it's absolutely mind-blowing. Absolutely mind-blowing. Let's see what Rob says here. You're onto it, John. Its uni PhD courses teach hedging to lock in price, not manage the position, fixing price with a hedge based on their law of creating certainty. So fixed price, lack of trading know-how, as you say, it also applies to super funds. It's absolutely scandalous. And of course, it's got to be very, very extreme before we, the public, ever find out about it. Because journalists, to keep, as I say, the journalistic captures abound in financial markets. And journalists don't want to ever write the bad news. If it can be avoided, it'll be avoided. And why is that? Well, media, newspapers, television, etc., they're the beneficiaries of business advertising. It pays to have good relations. They're the biggest clients of the media. They're the guys who spend the money. Jeff, wouldn't it be better to use options? I'm a great critic of options. I think that they're a dreadful tool. But if you know and understand options and feel comfortable with them, Jeff, it may be effective. The problem is, if you're buying calls or puts, you've got a massive bias against you because the guys who are writing the options, they're probably better informed than the punters, and they're certainly more skilled. And there's that really simple story from last year sometimes with that company GameStop that I'm sure you'll be aware of. And there was a whole lot of meme, M-E-M-E, meme players. And it was the theory was that these were all young guys who had pockets full of cash from the COVID advances and payouts and what have you, and they were locked down at home and wanted to play the market. Of course, that was the total furphy. The big push. That particular company was 140, 160% short interest, and all created mainly by a big, very, very well-known hedge fund and its associates, and struck a nerve. You guys are writing madly. I'll come back to all of you. I won't ignore any of you. Thank you. I love it. So, yeah, long-term capital, it's exactly the same thing. The smartest guys in the room, but just didn't understand the basics of how financial markets work. And a hedge is not a hedge when you think the physical is the hedge. And the physical is in the ground, or in the case of the nickel company, you might be a massive producer of nickel, but if it's not the right quality and specifications to be lodged at the LME as settlement, you're in trouble. And that's just what's happened. And it just seems to me extraordinary that we have all these clever people on massive salaries. Presumably they're educated, presumably they all go to a business school somewhere along the line, and they don't know anything. They don't know simply when a hedge is not a hedge. And the damage to shareholders, there's no great rage about any of this, of course, partly because the media, the Australian and Wall Street Journal in this particular instance, they present it as, oh, well, it wasn't trading, it was hedging. Well, of course it's trading, it's derivatives trading, it's probably futures hedging. And it wouldn't matter whether it was futures, options, private labor, whatever, it's the same thing. The player has taken a view of the market, in my view, the cardinal sin. I always say to my students, if you think you know what the market's going to do tomorrow, you're in trouble. You have to reach that state of nirvana where you're happy to say, I have absolutely no idea what the market is going to do tomorrow. But the last completed bar, if you understand the Danielcode, the last completed bar tells you exactly what are the optimal orders to place to take advantage of the probabilities, because trading is about probabilities. There are no certainties in trading in the same way as there are really no long-term certainties in life, except death and taxes, as we know. But this stuff is, I repeat it, is this negligence? Is this willful malfeasance? Is it just ignorance? They put these things on, forget about them? I mean, surely to God, that sort of money, there's some oversight as to the risk you create every time you put a transaction on. But the reality is showing us that there's not. And, you know, I mean, it's absolutely staggering. So I've called this webinar today, Trade Your Dreams, Not Your Fears. And we've had just such a wonderful 10 or 12 days of trading, honestly. It's all your Christmases come at once. It's beautiful, and I really have felt for the last couple of weeks that I've been in trader's heaven. It's just been delicious, and our orders have just been wonderful. So your fears come if you're a trader. You've probably got fears, unless you've done a Danielcode tutorial and know how to totally control those fears. You probably suffer from a lack of confidence in your trade selection or your trade program, or you think or might even know there's too much risk in your stop loss regime. So that's what causes fears. Dreams arise when you have confidence in your trade selection and your trade management. And the vaccine for trading fear is the Danielcode. Once you understand how to trade price at the Danielcode, or better still, you make the jump to a tutorial and learn how to trade time, then you will fear nothing. Trading price in all markets, in futures and Forex, markets will turn at and only at the Danielcode price ratios. And that's why I spend 70 hours a week putting out all those charts that you see in members' charts. And that's only half. Don't forget, we publish some of the futures, some of the Forex, the more popular ones, but I create charts for double that number. So for the other markets we cover where we don't publish members' charts, I've got members' charts and I'm looking at them every day. And if they're creating signals, excuse me, I'm putting those signals up either in the TO3 or the TO3 Plus program. And the Danielcode creates really firm levels of security with its selections and rules on trade management. Once you understand Danielcode trading, you will be able to say, put your hand on your heart, say, I have risk absolutely controlled and managed in the best possible way, and a way I am comfortable with. And that's the first step of treading away from fear and heading towards trading heaven or your dreams. So it's there. All you got to do is want it. Okay, so let's have a look how these TO3 and TO3 Plus trades have been going this week only. Monday, 11 trade signals. This is Forex and futures combined. 11 trade signals, 8 elected, all are profitable. Tuesday, 15 trade signals, 14 elected, 13 profitable. Wednesday, 9 trade signals, 8 elected, all profitable. You can see why I've been so excited about this trading recently, and it was the same the week before. Thursday, 7 trade signals, 6 elected, 4 profitable, 2 pending. Lots of signals, high success rate. TO3 and TO3 Plus signals are the first steps on your journey towards trading heaven. And I post those every day, as you know, as soon after 7:30 p.m. each day as I can. Have a look at this. This was copper. Wasn't it marvelous? I mean, it roared up to 495.05. Danielcode blue line. That was DC target recognition. Hit that. Bye-bye. 3 bars down. Big bars. lots of money, wonderful trading. US dollar index, exactly the same. This doesn't have Thursday's price bar on it. Those of you who attend these webinars regularly know that I prepare these things around 4 o'clock in the morning, and sometimes I haven't got end of day data loaded up there. But today's been, market sort of lost a bit of push, hasn't it? It's having a thinking session, lots and lots of inside bars, with the market scratching its head thinking, do I go on with this correction or do I go back to the original trend? And Forex, I mean, look at this trade here. We've been short this thing twice, right from the high. 2 short trades, maybe 3. We had an outside bar in there, which was stop and reverse in there. But we've been short this thing from the absolute high. And of course, where did it stop? 108.061. There was a Danielcode target recognition on that low bar, which would be Monday's bar. And then Tuesday, not much conviction to it, little move up. Wednesday, big whoosh. Today, thinking time again. But it's been marvelous, marvelous trading. Here's oil. Got the little inside bar from today. DC target recognition, key reversal bar at the 130.70 blue line. I mean, extraordinary how these numbers, because when you get something like oil that's been rallying for month after month after month, every one of those daily, occasionally the 1 bar, but more often the 2 and 3 bar corrections, that creates a whole new list of Danielcode targets. So you finish up with so many blue lines stacked together when you're looking at a market like oil that's been rallying for long periods, weeks, months, in fact. You get so many of them, but it doesn't matter. The only ones that count are the ones that the market shows you gave you Danielcode target recognition, which we say it's within 0.1% in price. Not 1%, 0.1%, 1/10 of 1% in price. And in reality, the variance is much, much less than that. We're looking normally at a handful, 5, 6, 8, 7 ticks, that sort of level. I mean, the accuracy of it is uncanny. You don't have to guess, the market shows you. And that is a great thing. Right, here we are, T-bonds, same thing, ran up, hit the red line at 159.23, that was its target recognition. Next day, key reversal bar, often a pointer of momentum. 3 bars down, very nice, that's lobbed up in, I mean, no time at all. $1,600, it's quite a small contract, pretty nice stuff. Here's CAD Chief. Now, think of this. Don't forget the correlated trades, okay? So, for example, we cover CAD Chief, CAD JPY. Often you'll get, as happened here, you'll get a signal in one, but not the other. So in this case, we had a TO3 plus buy signal in CAD JPY. That's Canadian dollar against the Japanese yen, that pair. What I've noticed and told some of you is that the correlated market, not the market that's actually nominated in the signal, will tend to do better. And with correlated markets, it's valid to take the trade from any market in a correlated market, providing the trade is elected. And that's what's happened here. The signal was in Canadian dollar Japanese yen pair. The better trading result was in the Canadian Chief, Canadian dollar Swiss franc pair. And that happens often. So be aware of that, folks, and look for that. It's an interesting phenomenon. Why does that happen? I guess it happens because less people know about it. It's a bit like, what are the best markets to trade? Well, the answer is the markets that have the least commentary. What are the worst markets to trade? The ones that have the most commentary. S&P and gold. I mean, the reason you just keep getting these minor counter trend is commentary. If you can find a market that's got less commentary, it's going to be a better trading market. You know, a few of those. Have a look at this beauty here. Euro Japanese yen down, down, down. All things euro have been getting flattened. Two little counter trends. One of them only one day. Dive straight down into target recognition. 124.474. Which also just happened to set up a TO3 plus buy signal. There's no happen to, that's what happens all the time. 1, 2.5 days straight up, and a pretty significant move up. Very, very nice. Okay, that's why I'm enjoying talking about trading heaven today. That's where I've been for the last 2 weeks. This is the euro pair with the US dollar. Same thing. All things euro getting punished. Down it went, down it went, down it went. All TO3 sell. Sell, sell, more sell. Hits the blue line 108061. A handful of ticks the variance. It's DC target recognition. It was also a TO3 buy signal. It's given us 2.5 days. Excuse me, straight up. Very nice. Okie doke. Let's see what else we've got. Same thing. I'm repeating myself here. I'm trying to make the point of just how terrific the TO3 and TO3 plus signals have been since I spoke to you last. Absolutely wonderful. Here's the inverse view. This is the dollar CAD, the so-called loonie. Rally straight up into a Danielcode blue line, which gives it a TO3 signal. Inside day, and then today it's starting to unwind a fair few of those, or a fair bit of that engagement, and looking at the stochastic might have further to go, we hope. So why are we so involved with turns? Well, all trends begin and end with a turn. And that's why we're so addicted to them. When I started off the Danielcode, I only gave you TO3 signals, and all TO3 signals are reversals. That's what they are. All TO3 signals are reversal signals. And that's the tough bit of it. And then I added the TO3 plus signals, which takes those reversal signals but adds to them some continuation signals. But we're going to be able to show you some very, very sophisticated and profitable way of trading continuation signals in the next few weeks. I'm just finalizing that now. A very interesting approach and a new option for you guys to look at. So the other part of the trading equation is stops. And the simplest stop loss is a 1-bar stop. And in the same way, the simplest and a very effective exit is first profitable close. Or if you don't sit in front of a computer watching live markets, first profitable open works just as well. So why is this such a popular method? Well, when you're talking about turns, the probability is, well, your certainty is when you're trading turns as we do, your turns are against the apparent trend. And if you take any trending market and look at the turns that give you a trade against the apparent trend, they have a high rate of failure. So to use an exit, the simplest form of exit, if you're new to trading the TO3s and TO3 plus signals, the simplest form of exit is take the first profitable close or the first profitable open. And that's because that gets rid of the obligation of having to determine the ongoing trend. And the first bar in a turn is often quite confused. Time signals might have created it, Danielcode price signals might have created it, but the great unwashed out there in the trading sphere, the day traders, they don't yet understand that yet. So there's resistance, and we'll often see in these TO3 and TO3 plus signals when they're coming off the first bar of a turn, that first bar can be quite confused. There's momentum up and there's pushback the other way. It's infrequent but lovely when it does happen that you get a really big solid bar and you can say that's given us a high excuse me, probability of a trend change. But that doesn't happen all the time. In fact, that's the minority. But once we go past the 1-bar stop, it then involves a view on the probability of the trend. And that's harder, but quite manageable with the system. Systems always rule. Whatever you're doing in futures and Forex trading, if you don't have a system, then you're tied to ad hoc decisions. And you'll make those decisions and you'll be unhappy with them and you'll chop and change. You'll do something different all the time. The beauty of a system is that you have quantified and regulated the rules of that system. You're going to make the same decision all the time. And if it's a proper system, making those same decisions all the time is going to be profitable for you because you're going to be have more profitable trades than losing trades. Or you might have a situation we see a lot with the Danielcode, that the winning trades are twice or more the losing trades on average. I repeat that the average winning trade is twice or more than the average losing trade. Quite extraordinary what that does to your equity curve, because if you've got that particular characteristic built in, it means you only need 25% win rate to break even. And Danielcode runs at 55 to 65% win rate. You've got a massive, massive mechanical advantage just by the way the program's been designed. So think about that, folks. And let me see, we've had a whole lot of comments today. Everyone got interested in this, so I'm thrilled that I've started some conversations on here. Jeff says, would it be better to use options? Yeah, if you're short term, I guess, Jeff, that's certainly an option. David, John, correct. Here we are, actually ramming futures trades in the form of a hedge is what the swathe of salespeople at banks and investment banks are employed to do. Many times even the salespeople do not have the requisite knowledge to know the product they are pushing. Akshay's writing this. He's a very smart guy, Akshay. Been a Danielcode member for a long time and he's worked for some big banks. Let me see. He's saying that often the salespeople at banks and investment banks don't understand, have no knowledge, and the product that they're pushing is it's the same with the theory of buy and hold fund managers who go on holiday after placing a hedge or option to offset risk, and then let their client fund suffer. Once the loss, this is Rob now, Rob Henderson in New Zealand. Once the loss is crystallized, they gain access to funds and tell them hold for the long term. It's criminal stuff, isn't it? And it doesn't get talked about enough. It doesn't get aired enough. And there is a total conspiracy with journalists to not highlight this stuff. And it's a shame because if you know about trading, there's nothing to be frightened of, really. Excuse me. I had a fall on my driveway 10 days ago in that torrential rain we've been having. I was taking the garbage bins out, which are sort of sitting on a couple of wheels. You drag them along behind you. And going down the driveway, I had my yachting shoes on. That's practically all I own in footwear. I've been addicted to them for so long. But they didn't hold. And my legs went up in the air together, and I went down flat on my back like a pancake from a considerable height. And I've broken a few ribs, so if I've had to clear my throat a few times today, you'll forgive me. I can't have a full-blooded cough of it all because it's so painful to take a deep breath. Anyway, I've survived that before and will again. So here's Rolf, just arrived, running late. Sorry, you're right, Rolf. This is recorded, of course, like we record all of our webinars, and it'll be posted probably tomorrow, and you can go through it and enjoy it. So there we are, folks. That's pretty much it for today. Interesting that these ideas about your risk management. With this mad volatility that we're getting, completely blows your risk management out of the water unless you're careful. Be careful. Never risk more than 1.5 times ATR, simply because that Danielcode makes its money on a sequence over a long period of trades. once you get too big a risk in one trade, it throws off that sequence. So be careful. Keep your ATR up to date, but don't get too short. Don't start looking at 7 and 14-day ATRs. If you're doing that, you're simply reacting to the market, and I don't want you to do that. I want you to stick to your management, stick to your discipline. Most important as we go on getting volatility. The money's there, you'll get your share of it, and if you're a good trader, you'll get more than your share of it, but don't chase it. Okay, there are plenty of other markets around. So do learn to trade the Daniel Code, and you'll be living in trader's heaven forever. Okay, let me see what I've got. Even, I missed that point, that was terribly important, that I've got from Greg Palladini and from the other Greg in Colorado Springs / Texas. They're both money managers, and they're now starting to say Daniel Code is more than a hedging option for their stock portfolio. It's a wealth creator as a standalone program. Huge endorsement that. You should give it some thought, folks. Okay, I think that's us. This is the Daniel Code video tutorials. If you want to be a super trader, let me know, jneedham@thedanielcode.com, and I will be happy to send you some material. And if you like, I'm happy to call you and have a chat about your trading, where you're at and where you'd like to go. If you haven't already, do help yourself to a free trial. There's so much you get from the free trials. It's marvelous. You get everything that we do. You can have a look at it. You can see which of the various products that we create suits your particular risk appetite, and you can choose for yourself which program you will lock onto. Okay, so don't forget, business of trading is making money. It's not about being right. We talk about it all the time, but we have to be right to make the money. But the business of trading is making money. That's our sole purpose here at the Daniel Code, to make money and help make money for you. Do pay attention to the disclaimer, folks. It's really, really easy to lose money trading futures and Forex if you don't know what you're doing. Do not, I ask you, I beg you, I implore you, do not risk real money trading until you are satisfied that you are a competent trader. Otherwise, it's just too easy to lose money. So that's us for the day, folks. Jeff enjoyed that. Good, thank you. Oh dear, John, you did not hedge against your fall beforehand. Quite right, Rob. I'm an idiot too. It's just going on and on. It's driving me mad. I feel so stupid when you fall over in your own bloody property. There we are. Murph, thanks, Hank down there. Murph, yes, thank you. Yeah. Time for a Bloody Mary for my ribs. Absolutely right, Murph. That's the best suggestion I've had all day, and I'm going to do exactly that. Good. Rolf doesn't see that. That's fine. Dave, good having you, my friend. Come back again soon. And David Beechan over there in New Zealand, running his leader-follower program with Striker Securities, our approved broker. Good on you, David. Keep at it, mate. If you need me, just send me an email anytime. Always happy to talk, and so proud of you. That's us for today, folks. Enjoy your weekend, and be interesting. The market's had a bit big I'm thinking day today. Interesting, very interesting to see what happens next week. Remember the thing about problems in markets? There's never just one cockroach. And we've seen some really big fat cockroaches. As Murphy's Law says, there are many, many more cockroaches to come, and we might see some of them next week. All the best for now, folks, and thank you for being with us today. Bye-bye for now.